Hi, good afternoon. Welcome to the marketplace. Coming up, Bank of Ghana Governor Dr. Johnson Esiama assures outlook for Ghana city remains largely favorable, but cautions inflation remains a major challenge as he opens Monetary Policy Committee meeting today.
There are also geopolitical tensions and evolving global trade dynamics, including the recent US-led tariff disputes. These have heightened market uncertainty and could affect commodity prices and could affect financial flows in emerging markets like ours.
Also coming up, a proposed 5% U.S. tax on money transfers sent abroad by non-citizens could have ripple effects in Ghana. We have a discussion ahead. My name is Darryl Kwao. Thanks for joining us. Details coming up. All right, first up, Bank of Ghana Governor Dr. Johnson Esiama has assured that outlook for Ghana remains largely favorable. This, he says, is based on measures that the Bank of Ghana is currently implementing. The governor gave the assurance at the opening of the Monetary Policy meeting at the Bank of Ghana today. Dr. Esiama, however, maintained that the outlook for inflation remains a major challenge. Here's more in this report.
Addressing members of the Monetary Policy Committee at the Bank of Ghana, Dr. Johnson Esiama noted that the current situation shows that the central bank may have to do more to ensure that the current gains are not eroded.
In March, the committee responded decisively to the inflation outlook by raising the policy rate by 100 basis points to 28%. Preliminary evidence right now suggests this action has contributed to dampening inflation momentum. And importantly, the cedi has appreciated sharply by nearly 19% between April and May, helping to ease imported inflation pressures and restoring public confidence. The appreciation of the cedi reflects a combination of factors, including prudent monetary policy, the improved market sentiment, as well as the external sector gains that we are witnessing.
The governor also highlighted some of the major contributing factors to the city's performance over the past months.
We are also seeing encouraging signs of macroeconomic progress. For example, Ghana has reached a staff-level agreement with the IMF regarding the fourth review of the ECF program. And although some prior actions remain outstanding, the trajectory is clearly positive. Now, you also would have heard about the recent S&P upgrade of Ghana's sovereign rating from a selective default to CCC positive, which further affirms this progress. Our external reserves have strengthened, and the trade balance has improved, as well as the consumer and business confidence indices rising steadily.
But despite this favorable development, the governor of the Bank of Ghana was worried about the outlook for inflation.
The inflation outlook, while improving, remains vulnerable to second-round effects. Food supply constraints are still with us, especially from northern Ghana and the Sahel, and external price shocks, particularly given volatile global commodity markets. There are also geopolitical tensions and evolving global trade dynamics, including the recent US-led tariff disputes. These have heightened market uncertainty and could affect commodity prices, could affect exchange rates, and could affect financial flows in emerging markets like ours. In this context, colleagues, the bank has commenced a comprehensive review of its monetary policy implementation framework. We are transitioning from reliance on the unremunerated cash reserve ratio to a more active open market operations regime, including the use of longer tenor BOG instruments, as we announced at the previous MPC, the maiden MPC that I had.
The governor, therefore, Dr. Johnson Isiama, therefore advised members of the Monetary Policy Committee to look at all the challenges and ensure that they approach the meeting with some rigor, independence, and professionalism.
Well, let's discuss this further. Joining me on Zoom, Associate Director at Deloitte Ghana, Dennis Brown. Good afternoon to you. So the governor today's presser said there were 3 questions they would be deliberating on during the MPC meeting. I want to ask your view on those questions. First off, he says they would assess if the current monetary rate stance remains adequate to drive disinflation without undermining the fragile growth momentum. Is that the case?
Yes, so good afternoon, Daryl, to you and your viewers, as well as your listeners. So, I mean, that is standard procedure, in my opinion. That is what is done during every MPC sitting. They would have to assess the impact of the previous rate setting and decide whether, to maintain, increase, or reduce it based on other factors as well. I think our approach has always been mainly inflation targeting. So the number one indicator that they will look at is inflation, whether it's still high, in terms of what we want to achieve, the overall economic goals we want to achieve, whether it's relatively too high, and therefore the monetary policy rate may have to be increased to, if you like, discourage consumption and to avoid demand pull inflation, whilst at the same time also encouraging investment into the real sector instead of it being in the monetary sector or the financial instruments. So this is standard procedure. This is what they did in previous sittings, and certainly they would have to do that again.
Yeah, I guess my question was if the current monetary rate stance is adequate to drive disinflation. Your thoughts?
Oh, okay. I mean, as to whether it is adequate or not also depends on what has happened in between time from last March when they said it at, I think, 28%. They increased it by about 100 basis points. In between time, at the time, inflation was around 23 to 24%. And although they acknowledge that at the turn of the year, there's been quite a number of positive in terms of the direction in which the economic environment is going. There's been growth. There was a strong revenue performance, via gold and cocoa. The reserves are also, gone up, and there was marginal improvement in inflation. By that, I mean marginal reduction in inflation from about 24 to 23.2% or so. Even though they acknowledge all the positives, they ended up increasing the monetary policy rate by 100 basis points because, in their own words, this will be required to anchor the disinflation process, which is to say that, yes, it has been increased previously, but we would have to tune it up a bit more because the reduction that has been experienced is marginal. The inflation needs to further go down. And so in continuing the disinflation process, yes, we recognize the positives, but let's tune it up to ensure we bring the inflation down further, maybe this time more significant. And what has happened over time, inflation has dropped from about 23.2% to 21%. That's not exactly marginal, like 2 months ago or so. That can be said to be notable, right? So clearly it's had positive impact in terms of what it did, right? Now, in assessing whether that is adequate or not, they would have to, again, like I said, look at the inflation. Yes, this time there's not been a marginal improvement, but notable. There are other economic indicators that are also in the positive in terms of direction. We are seeing exchange rate gains, not just stability. Stability has been experienced from the beginning of the year. In April, thereabout, we've seen appreciation, and we've heard that there's been, the reserves have been boosted as well. Currently, moving around 10.6 billion from the latest update I checked, right? So clearly, economy growing, all other indicators also pointing to, the positive direction. I'd like to think that they might see the current rate or the rate they set in March as doing what it's supposed to do, and therefore likely to maintain it. right? Worst case scenario, they might look at the inflation as still being high because it's still around 21%, which
Yeah.
is about 10 percentage points higher than our medium-term target of up to like 10%, and may then also say we can tune it further up because, well, it has served to bring inflation down. It can do better, so we can tune it up further up, maybe by 50 basis points or another 100 basis points, worst case scenario. So yeah, that's what I expect from
Yeah.
them.
Well, I want to chip this in because the president mentioned that while we talk about inflation, says the country could hit a single-digit inflation by middle of next year. How feasible is that?
Okay, by middle of next year. Okay, when I read that somewhere, I thought it was by middle of this year. So I was going to say
2026.
middle of next this year. That is too ambitious. But by middle of next year is achievable. If you look at the budget, they are targeting to hit 11.9 or 12% marks by end of this year, right? If that is considered achievable based on the trend that we are on, and even that can be a bit of an ask looking at the fact that we are still around 20%. It means we need to bring it down significantly by about 8 percentage points. And that's not easy, but yes, it's achievable. If we can get to that point, then of course we can build on to get to a single-digit inflation by next year. Yes, it's achievable, but it depends on the efforts and the policies that we put in place. And of course, in our type of market, there are other external factors as well that we don't control that may come to play. All of those things happening with the US trade war and all of that. So it's not just entirely dependent on the homegrown policies. There are other external factors that may come to play. Let's just, we are religious. So let me just say, let's just pray that, whatever happens externally continues to be in our favor, and then we can, augment it with our local policies and eventually be able to hit the single-digit inflation by next June.
Yeah, and the governor mentioned that in reaching the decision on the policy rate, they're also going to consider whether the city's good run, the appreciation we have seen in recent weeks, is sustainable. The governor admitting that, questions have been asked whether or not this is sustainable. Your thoughts?
Yeah, my thought has always been that when it comes to the strength of the city, the only way we can, sustain that into like the medium to long term is by changing the structure of our economy. And these are conversations that have been had at various fora, and the answer is quite clear. If we still remain import dependent, we are going to have to experience short-term, shocks. And what we try to do is not to really approach the problem, but to solve the symptoms, right? So when we talk about the FX reserve, we try to build enough reserve to cover, a certain short-term cycle, maybe 4 months, 5 months maximum, right? But when something happens that causes a rush for dollars and it depletes, faster than we get to add on, then, depreciation sets in. And so typically we are just managing the symptoms. Now, the effectiveness with which we manage the symptoms within that series of short-term curves will then prove whether we can do so sustainably over the long time. So take it as a series of short-term. Once you are, building up enough to absorb the demand shocks that are coming from the market, then you'll be fine. But ultimately, what would make it sustainable is when eventually within the medium to long term, we are able to, reconfigure the structure of our economy to one that is not highly import dependent, to one that has fixed the value chain deficiencies in various industries so that we are able to produce, to replace a lot of the imported goods that we know can be, produced and substituted here, right? And also to be able to export more than we do to, then boost our FX reserve. That really is what we at that point, then we can say we are at a point where we can sustain, whatever gains that we are making in terms of the stability in our local currency.
And they're also going to be analyzing if the market confidence we are seeing is durable. What say you? I guess Dennis is frozen there. Dennis, can you hear me? Unfortunately, Dennis appears to be frozen. Probably try and get back to him if we will. But you're watching the marketplace here on Joy News. We are taking a short break. We will be right back. right, welcome back to the marketplace. We're just wrapping up that conversation with Dennis Brown, Associate Director at Deloitte Ghana, on the MPC meeting, which opens today. Dennis, so we're talking about the governor saying they're going to assess if the return of market confidence is durable. What do you think?
Yeah, I mean, so I would say it's early days yet as to whether it's durable or not, but we have to look at it in terms of two different types of investors. So investors that are interested in, short-term investors, or are investors at the short end of the curve, and those that are interested in the long end of the curve, because then the gains that we've made will still be regarded as short-term, especially considering the kind of economy we've had previously. And they will still play what you call the wait and see approach, particularly those that are interested in putting capital in long-term projects. They would want to see it sustain for a much longer period before they make concrete decisions regarding their investment. But there are also investors that play in the short end of the market, where between 6 to 12 months, they should be very confident about investing because of the cycle. They expect that in a period span of up to 12 months, there's not much that can happen that will significantly alter the gains that we are looking at. So if you look at it, you have to bring in the dynamics before you can conclude as to whether the confidence we are seeing, be durable or not. We need to continue and persist on this path to then send the signals to investors out there that, look, this is something that is here into the future, and therefore they should come on board.
All right, yeah. We'll keep following. Thank you so much, Associate Director, Deloitte Ghana, Dennis Brown. Appreciate your analysis this afternoon. You're watching The Marketplace. Let's talk tech up next. So, a proposed 5% U.S. tax on money transfers sent abroad by non-citizens could have ripple effects in Ghana, where remittances are a crucial source of household income and national revenue, raising concerns about economic strain on families and reduced foreign exchange inflows. Joining me on Zoom, lead for Eyes of Africa, Henry Kobler. Good afternoon to you, Henry. So, how significant are remittance inflows to Ghana's economy, and what portion comes from the U.S.?
Thank you very much, Daryl. So if you're looking at the numbers that comes in, you're looking at almost about $4.8 billion coming into the country through remittances alone. If you're looking at the numbers, that is really higher even than our spend on education in Ghana in terms of comparing it within our GDP. And so it's quite huge when you're looking at the numbers. But again, the US is also looking at major targets like Mexico, which is having almost about $64.9 billion going into Mexico alone in a year, which is a higher numbers. And that's really what the US sort of is looking at targeting. If you're looking in Ghana, most of the very successful fintech companies that are in Ghana are sitting on remittances. And so you could really understand that if it comes down to even the startup and the tech ecosystem, the ones that are making the gains like ZPay are sort of sitting on remittances, and they're more successful within that point.
Yeah, I was wondering what the short-term or long-term effects would be if there were taxes, the tax goes ahead on remittances from the US.
I think it's early days yet until we basically see the full records of the taxes that is sort of going to come. There have been speculations, and if you're looking at what they're looking at doing, they're really targeting undocumented immigrants and how they're sort of looking at moving funds from the US. I mean, there are points where people who are citizens directly could be moving money into the country, and that could change the entire course of that tax system, because again, people are always going to find ways of evading the taxes. And so I could relatively now be sending money to somebody who's a citizen, and that person rather will be looking to be sending the money in there. I mean, different business models are going to pop up in that industry. You're going to have most of the startups and the ones that have invested so much into the craft and building mobile applications which is used in the remittance services, hitting on bedrocks. I mean, there have been quite a number of policies and regulations that have been coming up, especially within the African regions, that are seeking to guide the remittance points and even looking at factoring that in terms of the data and the GDP spend for the country. And so all of that sort of is going to start seeing some level of effect in terms of that. You're going to have technology being beat up now, because now people are going to start sending money directly like we used to do, where people will be sending money through people that will be coming into the country. Different models are going to start coming in. But again, like I said, that we need to have clarity as to what exactly they're going to, and the terms of implementations that they're going to adapt in terms of this particular tax that's sort of going to be in there. But for me, I can clearly tell you, it's really going to be on the downside for our country, for most African countries, even for major countries that like Mexico, that have major inflows of funding coming through remittances into the country.
I can imagine. I mean, people could start, and like you point out, would start using informal channels to send money to their families here in the country. And you know what that is, what risk would that pose? Also, how do we respond as a country?
I think that we've been on that side where we've not done too much to really give some level of response to some of these policies. I mean, Trump is a businessman. He's always looking at how he's going to make his country stand in that area. And so I think that what we could do in terms of responses, we could just have to do a lot of empowering. I mean, we've seen YEA trying to now push people out of the country in terms of some level of policy of getting people to work out of the country. Now, some of these policies now are going to stifle most of the fundings that's sort of going to come in, unless, of course, we're having a direct policy guide, which is coming in place with agreements from some of these major partners for us to be able to move some of these fundings into the country. Other than that, I think that we have really little to do in that effect.
All right, Henry Kobler, thank you so much. Lead Eyes of Africa. More news on our website, myjohnonline.com/business. Get the day's latest stories from over there. Yes, myjohnonline.com/business. My name is Darryl Kwao. Thanks for watching. We will be back same time tomorrow. Guess what? It popped up.